what I want to talk about is fix and flip financing, or you might call it ARV financing. And that's where you take the future, you borrow money based on the future value of the property. So what that means is that your loan is actually going to, a lot of times, be more than the purchase price of the property. So for example, and I'll give an example, but let's just say you buy a property for 100,000. These types of lenders will give you 70 or 75% of that future value. And so you would get a loan of 70,000. So for those of you who can't imagine this, let's say it's $1 million. Your property's future value is worth $1 million. You would then get 700,000, and maybe you paid, say, 450 or 500,000 for the property, and that extra money, that difference between the loan amount and the purchase price, is money set aside for repairs and improvements, the rehab that you're going to do. So, or maybe it's, building on or whatever, but it's whatever you're going to improve the property by that makes it worth that future value. So whatever that future value is, maybe you added bedrooms and baths, maybe you just did a cosmetic improvement, but whatever it is, that's what's being financed in, is to create that future value. So, so today I'm going to walk through, a property that we bought that fits this model. Yeah, I can get this Word document open.
Or stop breathing.
Or stop breathing. Well, I think muting yourself is a little kinder. Okay, so first, and then I'm going to go through a deal we bought and a deal we dropped, and two that ran away. I thought there was one that ran away, but I forgot about the other one that ran away from me. So anyhow, so we'll go over those real quick. Okay, so in this case, this property is the one you may remember, 1657 Delaware, or I think it's South Delaware. That one is near just south of the Butler-Tarkington core area. So it's within a few blocks of where properties sell for $300,000 and $400,000. So this one is a duplex. So it's actually 1657 and 1659 Delaware. The price we paid was $95,000, although it did start off at $99,000 was the list price. The after repaired value between 157, which is actually what the appraisal was, and 170, the lowest comp in the neighborhood was 165 for this similar style properties, similar bedrooms and baths, similar condition, although this property had a condition issue, so we'll talk about that. So that's the ARV. The loan amount we got was 1,099. So we got 70% of the 157 as a loan amount. The repair escrow, meaning the repair bid that I got from Chris, the contractor that PMI Indy uses for their work, or to manage the work crews, that was the bid. And then our cash to close. So after all these pluses and minuses, and I'm going to walk you through the closing statement, so don't panic that this makes no sense. So our cash to close was $79.70. The holding cost, this is a very expensive loan, right? It's 12%. The seller would not give us any more extensions. It took me forever to get bids for the work. So we had to close in 2 weeks. Had I had 4 weeks, I could have gotten another company who's at 7.75 interest. So that would have been much better. But unfortunately, I burned my candle out, and I had to close with cash, or else they were going to move on. So the estimated time to do the repairs is about 2 months. I think maybe it's going to be closer to 3. And then the time to rent it out may not be 2 months, because Anne is already setting it up for marketing, but I'm giving it a couple of months, right? So my total time, I still counted 6 months. You don't want to do your budget on the minimum times you think it's going to take to do repairs and such. So I've got 6 months. Now, my first payment is due November 1st. So it would be great if in the month of September, October, we make a lot of progress, because then maybe I'll only make 1 or 2 payments. But just keep that in mind. Whenever you do a loan for your own self, you refinance, you purchase, there's always some prorated interest at the close of escrow. And I'll show you that on the estimate. But there's always a little bit of interest, because they're prorating so that you can start your mortgage payments the next first of the month. In this case, this lender called Longhorn. They're in Texas. Longhorn Investments. They collected a full 30 days of interest because we closed September 2nd. So they didn't want to have fewer than 30 days before the first payment's due. So they collected like 28 days of interest. And then the first official payment that will come out is November 1st. And it's on ACH. So I'm not having to mail the check. They're just going to auto debit it from the account. So the owner of this property is At Home in Indy LLC. So that's the bank account that the payment would come out of. Okay, so that's kind of the simplistic way of saying what the numbers are. Then we've got how's the cash flow. Remember, you want an exit strategy, more than one exit strategy. So we look at not only the rental income you can get, but the ARV. So maybe you can sell it. Maybe you can do seller financing, sell it and carry the paper so you earn that interest. There's all kinds of ways to do this, right? So we start with the basics. Is our gross rental income is somewhere between $750 per side and $850 per side. So I used $1,500 less the vacancy. Now, keep in mind, we'll probably have zero vacancy because it's vacant now. So if they place tenants and they choose the tenants well, we shouldn't have a vacancy the first 12 months, but you always do your numbers on, what it could be once it's stabilized. So year 2, it's very possible that both people, one person, someone might move out. Now, these are 2-bedroom, 1-bath units, so probably they won't move out if it's in good condition and they're happy there. Okay, so our loan amount, so this is your after repairs, get a normal loan, get it rented out. So, over the last couple of years, Bigger Pockets has made this term BRRRR popular. So you're buying, you're renovating or rehabbing, you're renting it out, and then you're refinancing. So that's the BRRRR. So our loan amount is going to be the future value, whatever the appraised value is after the repairs. Now we probably could go 75 or 80%. So our loan is going to be somewhere around $123,750. Our mortgage payment at now 4.5% instead of 12%. Principal and interest instead of interest only. I think I skipped that earlier. The rehab loan is interest only. There's no principal. There's no point in paying principal. So our loan at 4.5% is $627. The property tax bill, and we've talked about this a lot, but I think this is good to revisit. The tax bill now is $1,026 per year, but being that it's a rental, eventually they could charge me 2 times or 2% the purchase price, right? So $1,900 probably is the property tax bill in the future. But so far, none of my properties have been reassessed, and I don't know how long it takes them to get to that point. So, but I still in my numbers use the future tax bill. The only time you might not have to do that is if you are the lender and you foreclose. So for example, on the one on Olive, I don't anticipate them reassessing that because I foreclosed on that property through the note, right? So I didn't purchase it. So there was really no grant deed. It was done through a lender's deed. So I think we're okay on that one for a while. But even still, even if we weren't, my foreclosure amount was about $70,000, I think. And 2 times that is $1,400. And the current tax bill is $1,500. It's not worth debating, or it's not worth asking for readjustment for $100 a year, but just keep that in mind that, that if you're a lender, you typically don't get reassessed. Okay, the tenant in these units, the tenants pay utilities, so there's no cost there. Then the management fee, we could argue to do it on the $1,500 or the $1,300, but because I used the $1,350, then 10% of that is $135. In actuality, our management fee is a little less. I think it's 8% because we gave them a portfolio. We have several doors. So there's, with PMI Indy anyway, they give you a discount. And then the $50 is for the lawn maintenance. So you might think, oh, it's not $50 a month. No, it's not. But you don't mow the lawn when it's covered in snow. So we just have, and the tenant's responsible for, shoveling or plowing the snow off the walkway and the parking area. So I just took the $40 per time, so $80 times about seven months divided by 12, and I rounded up because I don't think it was $50. So that's where those numbers come from. Now, normally I would also have a repair reserve account of $150, but because it's just been rehabbed, I probably don't need that. And more, I think if you have a reserve, let's say you have 3,000 in reserves for things that come up, then you don't double ding yourself. In other words, you're not going to count a repair reserve in your cash flow when you've set aside money for repairs. So keep that in mind. If you do have the money to set it aside, then you can take that out of your cash flow analysis. Okay, so our net rental income is $259.98 times 12. Remember, we're always annualizing these numbers. So that's $31.19, per year in cash flow. So now our net cash investment, and this is where when you do a rehab loan and you get most of your money out, it gets tricky because it's not just down payment, repairs, and closing costs as your cash investment. In this case, you have very little left in the property itself. In other words, you've gotten your money out of the property, right? So we've got $123,750 is our new loan. Now we're paying off the old loan, and because there's no principal, it's interest only, I still owe what I did when I started, so that's $109.9. Then I've got the $79.70 that I originally put into the property. I'm paying myself back on that, and the earnest money, so I'm taking that out. I'm taking out the interest that I paid during my holding time, right, during my rehab time. And so that leaves me with $22.14. But don't forget, I'm refinancing. There's costs involved in that. So I really should have taken that out maybe up here saying my new loan's $123,750, but I don't get that money in my hands. They're going to take out their closing costs, right? So I just put it here so that you plainly see we got to remember our closing costs. So that means I have $52.14 approximately. These numbers will change as time goes by and we see how this develops, but this is my beginning point with my numbers is I've got $52.14 in the property. Okay, so if I scroll down, before I do that, so my next line is the net equity. So I can rent it out and have cash flow, or I could sell it and cash in, right? A lot of flippers, that's what they do. They do it so that they can build their pool of money. So my net equity is going to be the 165 value minus the one, to make things easier, I did 124 loan amount. So I've got 41,000 in the property. Okay. Now what's my cash on cash return or my ROI? I've got 31,1976 in cash flow divided by the investment money that's still in the property, so to speak. So that's a 59% ROI, right? So what if I did set aside that 150 in, maybe I don't have the money anymore, which is not a good thing, right? But let's say I don't have the money in cash reserves, I'm waiting for the income to come in, then I'm only making $109.98 per month, times 12 is $13.19 divided by the 5,200, that I'm only making 25% return. Now, that's a good return, but keep in mind that these are small numbers. Any little thing can come along and blow out that $100. So normally you'd say, well, why are you doing this? A 25% return sounds really good, but these are tiny numbers and tiny numbers get wiped out. I mean, that could be a screen door, right? So that's not great, but I'm liking the equity. So it's kind of a trade-off, and it's also for the neighborhood. So if the neighborhood were not up and coming, and let's say this property was only worth 120, I would not be doing this deal, right? So because the equity's there, and hopefully our budget stays the way it is, in other words, my repair costs hopefully won't go up too much. I had figured 25 or 30 would be my max because I've got to have some money left in the property to make it worthwhile to do this deal. So another term that we've learned but not talked about a whole lot is the IRR. So your internal rate of return counts the cash flow, but also counts your payoff day. So whether you sell a year from now, 5 years from now, 10 years from now, when you count that equity that you cash in by selling that and you include it in the return, they call that your internal rate of return. Now, some websites, some wholesalers, some websites that sell turnkey properties and other types of properties, they try and convince you with this number. So that's also a dangerous thing. You know, if they're saying you're going to make 41,000 and what they're doing is they're counting the increase in value over 5 years. So let's say I bought this for 120 and it increases over 5 years. And let's say it's worth 130 in 5 years. They would say, oh, you've got a, 200% return. But in reality, a lot of times they don't count it over 5 years. So you have to make sure that when you see an internal rate of return, you know how many years they're counting on to get that. Because that could be future fantasy money, right? We don't know. So you want to count today's value if you're going to do something like this to see if it's worthwhile. So I've got my $1,300, I'm only making $100 a month on this property times 12. So 109, it's almost $110 per month times 12, plus the 41,000 in equity that I cash in, divided by the investment money I still have in the property of 5,200, gives you an 811% return. So if I do that, like house flippers, right? But what's not in here is, did I sell it and pay capital gains? I should deduct that. Did I sell it and do an exchange? I'll have closing costs. I didn't even count closing costs here. So these are very simplistic numbers, not including all the things that can come along. And in fact, this $1,300, because I spent so much fixing up the property, probably is not even taxable the first year. So there's a lot of tax benefits and tax costs here that are not taken into consideration. But this is just to give you kind of the idea of, the before and the after, and does it still make sense, right? So I'm just going to pause there and see if there's any questions. Does anyone have any questions?
No.
Okay. Or you can always stop me and ask when we get to.
Hey, Athena.
Yeah.
Hey, it's Lauren. Can you remind me again, how did you find the property? Just through one of Tyler's listings?
This one was just on the MLS.
Oh, okay.
Okay, so now let me find our closing statement. I thought I had it. Oh, I know where it is. Okay, so this is, hopefully most of you have seen this, but if you've never bought a home or an investment property, or maybe it's been a while. So this is a closing statement. Typically, you as a buyer don't see the buyer and the seller sides, but so that's what they call a master statement, as opposed to a lot of times you as the buyer will just see your number. So you just see the right side of this ledger, right? If you're the seller, you get your side of the ledger, but this is a master statement, meaning it's both sides and they should balance down at the bottom. So it tells you who the borrower is, who the seller is, where the property is, who the lender is, which is interesting. So Trident Realty must be the actual lender because Longhorn Investments is who the lender was. So this must be the actual note holder, which is different from the broker that brokers it. Okay, so if you have questions about the seller side, you can ask me. It's very simple because it looks like they owned it free and clear. I'm going to focus on the buyer's side, which this should say buyer, not borrower, but that's okay. Okay, so you have a debits column. So debits, means minuses, money going out. Credits is money coming in. And then down at the bottom, those two columns should balance, right? So if we go down here, these two columns should balance. Okay, so we've got our price. Okay, then we've got the earnest money deposit, EMD. What's interesting is some states allow the realtor, the broker, the seller's broker, to hold on to the deposit, which always made me very nervous. But so far, nothing bad really has happened. But if the seller refused to give you your money, that would, it's not a neutral third party. That's what bothered me, but it's how they do it there. And I guess I could insist on giving it to title instead of the seller, but anyway. Okay, so then whenever you buy a property, there's going to be a balancing of the tax bill. In this case, the tax bill has both the actual tax bill and other stuff, right? So the assessment, I forget what this is for now, but yeah, I can't remember what this assessment was for, but it's instead of having like our tax bill here in LA County has all the different stuff on one page and then you pay a total. In a lot of states, a lot of counties outside of our state, they actually break it down into every, like the school district will send you a separate bill. The water department, the street bonds, you know, they'll have separate bills for all this stuff. So you want to be very careful because if you're not aware of that, you might calculate your tax bill incorrectly, right? Okay, so the county taxes are $1,303, which is a little different than what my number had there earlier. Then we've got the new charges. So commissions, we don't care. The seller pays the realtors, right? So good for them. They made money. So the new loan charges are to do with your lender, right? So here the origination fee is 3%. And you thought, wow, 3 points. I'm sure you're thinking that. The reason it's high is because it's a net thing. So for example, when a mortgage banker makes a loan, when we make a Fannie Mae loan, we make the loan, we sell it, and then we get paid. In this instance, they're doing a hard money loan. They're not really selling it to anyone. And there's no prepayment penalty on this loan. So they know that in a few months, they're going to have to reinvest their money again. Now, don't cry the blues for them. They are making 12%, right? And if they can turn their money every 6 months, which is not possible probably, but could be. If I pay them off in 4 months, they can definitely reinvest that money and get another. So, you know, they're making pretty good money. But that's why they charge points up front is they may have to extend me 9 months or 10 months, right? So my agreement says they can extend it if I need it. Then you've got and that's a tax deduction. Then you've got the appraisal fee. They did not charge my credit card. They got paid at the end. This guy got paid at the end. And then the flood certificate, there's my construction repair account. So Longhorn is going to hold this money. And as I do work, reimburse me, right? So that's one thing you have to know is that if you want to do one of these things, types of loans, and you don't have the cash to get things going, then you're going to need a partner who can do that or another lender who can lend you to do that. Then you've got your doc prep fees. They actually have attorneys doing their loan documents, but in a regular loan, a lot of banks charge for loan documents, or that fee will be in the underwriting fee or something like that. Then they've got their admin fee. So these are Longhorn's fees. You can see where it says Longhorn. The origination fee typically goes to the investor who lent you the money. Okay, so then here's my prepaid interest that I was talking about. So we closed on September 2nd. In California, you would get charged interest the day before you close. In other states, because you're funding and closing the same day, they're counting that as closing. So they only charge you interest from the day, the day you close, which is the same day as you fund, through the end of the month. Then your first payment's the next first of the month. So this is my prorated interest of $1,047. And my first payment then is November 1st, my first official payment. Then the title company has their fees. So they've got environmental protection lien fee. They've got, the encroachments fee. So they're insuring all these potential losses, right? So if the property line's in the wrong place, they're responsible, right? If they don't call that out. If there's some kind of environmental disaster and they didn't tell you, they're responsible. So these are all areas where they are, giving you insurance basically. And here in California, it sort of looks the same. They just don't break it down as much as they do here. If you've ever seen your title report in LA County, there's pages of things they list that they protect you on. They're listing them all out and their fees for each one. So the recording, obviously, the notary. So the notary is a traveling notary. Obviously, I'm not in Indianapolis, so they have a list of notaries that they have there, and they send out, here's a job for you guys, and whoever picks it up comes. And we met this lady who came before, so she lives in PB, and yeah. Okay, recording fees to their county. They break down, what costs what, which is way lower than LA County, obviously. Their transfer fee. Okay, the homeowner's insurance that we got is $867 a year. So you have to pay your whole year up front when you buy, and then it renews. Okay. So all this stuff adds up, but it doesn't. So here, balance due from borrower. So we had to give $79.70 to close. On the seller side, he didn't have hardly any costs. So, he got out $86,000. And then the title officer, or in our case, the escrow company, would sign off on it. Okay, so let me just go back up here. So mainly I just wanted to show you that your price is a certain amount. Now, what if I'd gotten $120,000? That's what I was hoping for. If I'd gotten $120,000, I would have bought this property zero down. And then this money here, let's say that would have been $21,000 or $22,000, would have been set aside for the repair escrow. Now, the minute I pay out, they're going to go inspect, see that the work that I said is done, and then they send a check. Every time you ask for a draw, it costs you money. Usually with these lenders, about $100. So this is not a cheap loan. And so you only want to use this type of financing if the property is cash only, right? If it's cash only, this is the only way to do that. They allow financing of this kind because basically they're lending on the future value, not on the condition or on your qualification for that matter. So let's say you have trouble qualifying. This is the type of loan you're going to want to do because they go just by the equity in the property. And the key is really that the future value is high enough to justify this expensive loan, right? Because it is an expensive loan. But my other choice was $95,000, put 25% down, right? Whatever that would be. Let's just say 25,000 to make it, let's say 25,000 to make it easy. And then I would have also needed so I'd be into it 40 to 50,000 out of my pocket. In this case, I won't be. Even if I go over budget, I may have to pay for that out of pocket, but I'm not 40, 50,000 into this property because then I would have to refinance. And the problem is getting cash out after a recent purchase is difficult. You won't get all your cash back out. So your money's stuck in the property. If you do a cash out refinance, you have to wait 6 months. And typically you're only getting 65 or 70% of the future value or the new high value. You're only getting 65 or 70% out. But if you did this is a rate and term refinance. In other words, you're paying off a loan to get a loan. Okay, so are there any questions on that? We can always come back to it if there are. And remember, this is recorded, so you can always, yeah. Go ahead.
For the hard money line loan, how far in advance did you get it? I mean, or, as you're looking through MLS and you find the home, do you then contact your lender about, so that we kind of talked about at the last call of looking like a cash buyer so that you have that higher, you might be a higher interest for a short term, but at least then you have the money at hand. But do you have that ahead of time before you make the offer, or as you're going through escrow, you're working with your hardline money lender?
Question. Yeah. So I had RCN lined up, the lender that only charges 7.75%. I had them lined up, but I was having a hard time getting a bid. Like we got accepted, I think on August 13th or 14th. No, must have been longer than that. Anyway, I was already into this 2 or 3 extensions because we had trouble getting I had an engineer go out there to look at the foundation and give recommendations. I thought I was going to have to lift the entire house up and rebuild the entire foundation. But the engineer said, well, here's what we recommend and blah, blah, blah. So, and they said lifting this kind of house is probably not a good idea. So, but anyway, so I had RCN lined up, but I had no bid for them, right? By the time I got my bid, and because I had to first get the engineer out there, that took 2 or 3 weeks. Then the contractor was ready, but he needed that recommendation to finish his estimate. So because I wasted so much time with those guys, the seller didn't want to wait. Well, RCN, from the time you give them the bid, they need 3 to 4 weeks to close. And the seller wasn't going to give me that. They wanted to close like the next week. And so and that was like the holiday was in there. So I said, okay, this hard money lender can close in 2 weeks. Can we close on right after the holiday? And they said, yes. Now it turns out, we were able to do it before, but, and mainly what delayed us was that appraiser. The appraiser took 3 days instead of 1 day. So, that pushes everything back, right? The minute someone's late. But yeah, ideally, if I'd had a better idea of the estimate, I could have gotten RCN going. But really, these hard money guys, they want the actual number we're going with because they go fast after that. So anyway, so that's why I had to go with the Longhorn people. And there's lots of these types of companies. There's another one called Civic that does the same as Longhorn. They go really fast, but yeah, they want your solid numbers because they don't want to have to change things over and over again, right? So, because basically companies like Longhorn have people like you investing money with them to then lend out to deals like this, right? So if you want to make 10, 11%, you would put your money with Longhorn if you're an accredited investor, or they have rules for savvy investors. So anyway, so you could, instead of owning the rental property, you could just sign up with Longhorn or one of these other places that are hard money lenders, and they lend your money out, right? So they don't want to change the numbers too much because they're identifying which of their investors is going to be funding this loan. And there could be a difference between 90,000 and 120,000, right? So it's their credibility with their investor as well. So
Thanks, Athena.
Hopefully I answered your question.
It does beg one question on Longhorn. So you're paying 12%, but what does the investor really get? There's a spread between the investor and the Longhorn.
Right. So I don't know what they pay their investor. You might want to go on their website and see, but typically the brokering company, like Longhorn in this case, the brokering company usually makes like 3% spread for doing the deal, 3 to 4%.
That's better than any CD I know, but there's risk, obviously. But wow. Yeah,
so you want to go with a company that does a lot of hard money, right? Like they know how to do future value. They know, that they do a lot, so they know what not to fund, right?
Right. You're not getting the best returns, but you're getting solid, people that know what they're doing, which is worth it. Yeah. Okay. Yeah,
because they have to have strong inside people to do the draws. So when you get money, they call that a draw. So when an owner wants a draw to reimburse for the work done, they have to have strong people, have picked good companies to go out there and inspect the property, right? Because if you sign off and it's not good, and then there's more problems down the road, that could be a problem, right? They don't want to own the property. They want interest.
Right.
So they have to be careful that they won't own the property,
Yeah, if you get stuck on that deal, the amount of months or whatever to get control of the property and everything.
And think about this, Keith, you saw this. Look at how many like rehabs gone bad are on the market, right?
Yeah.
So that's what happens. A hard money lender doesn't want to be the guy owning that rehab that's half done, and now they've got to plunk money into it to finish it, or find someone else to take it off their hands, which means now their money's tied up in that property and they're not lending it out. And their little investor is like, hey, you said I was going to get 12%. Now I'm getting 0, So they have to be pretty careful.
Right.
Okay, cool.
Thanks.
So,
Athena, did you say that Civic and Longhorn are similar in that they offer the fast hard money loans?
Yeah, Civic is
And
faster
RCN
than
is different?
RCN. Civic's also more expensive in interest. Yeah, they're more similar to Longhorn.
Okay.
And some hard money lenders only lend in certain areas, right? So Like I know a couple of ladies that are hard money lenders, but they're on the East Coast and they only do the Carolinas and Florida. So you also have to make sure if you're, vetting these guys out yourself, you want to make sure that they lend wherever you're going to be, investing.